income statement real quick. Now, if you're in the construction business, right, you're supposed to be on the percentage of completion method, right? Which basically you have to determine what the percentage of your profitability is going to be, basically, and you have to apply it to your earnings as you earn throughout the contract. And there's two ways of looking at it, right? One is the cost to cost method. One is the units of delivery method. Cost to cost is you basically know, you see if you had 30% of the cost at 1/3 of the time that the job is done, then you have to back into your revenue, right? And say, all right, my margin was 40%, 30% of the cost has already been incurred. I'm going to book 40% of the revenue at this point in time. So, cause I'm at that 30% mark, I'm going to book 30% of the revenue. That gets me to the 40% margin. So basically, you just don't take cash that came in. Say if the client paid you, which we all would want, 100% today, right now, paid you 100% of the job. You wouldn't, if you were 30% of the way, you would not record as revenue 100% of the cash you received. You would only record 30%, because you're 30% of the butt based on the cost. You incur 30% of the cost, so likely that should be revenue that's recognized. Now, what happens is that means that cash is basically, of course, is sitting on your balance sheet as cash from that as an asset, but it's also a liability. Meaning that if the customer pays you 100% of your job now, that's called deferred income. That sits on your balance sheet as a liability. Because if you say, you know what, I'm not completing that job. They pay me 100%. I'm going to Bermuda. I'm out. Right. Well, of course you owe that client money, right? Because you didn't complete the job. So you only complete 30%. So you at least owe that customer 70% back. So you wouldn't recognize that 70% as revenue on your balance, on your income statement as revenue. You would actually put it as a liability, deferred revenue, and it would move to income as you complete the job. So if you do 20 more percent, you have 50%, 20% of what's left on that liability would move to revenue, and the liability would come down. So when clients prepay you, it creates a liability because you owe them if you don't complete the job. Yes.
My question is, like, let's say you get a contract paid for X amount of dollars, let's say $300,000.
Right.
How much should you anticipate paying taxes on, and then and what do you do? Do you just try to put that money to the side as it comes in?
Well, yes. Well, that last part is right. You got to put that money aside. So you got to figure out what portion of that $300,000, and you got to put this aside to pay your quarterly taxes. Right? That's where a good accountant really comes in to help you with that. And part of it is that job, you should have already estimated, I guess all year I would have estimated what your margin would be from that job, right? Like before you start a job, before you enter a contract with a client or a customer, you've already calculated what your net profit's going to be, right?
Pretty much.
Or you should. You have to. That's how you stay in business, right? Because otherwise you're going blind. And you don't even know if you're going to make money to petty taxes. Like, you have to know. So if the margin's going to be 30% or 40%, right? Then it's really 40% of that 300,000 times, and I use an overall tax rate of 30%. Like the highest tax rate is 37%. But if you say 30%, I gotta, the 30% of the 40%, I gotta say it to the side and then get to the federal government when the quarterly is due. So it's important. Because everyone knows, like, if I say anything today, that's gonna be two things. The Kenneth's gap, you gotta always constantly think of that.
Yeah.
And your margin. You gotta know before you get to a job whether or not it's gonna be profitable. And the only reason I believe, right, that you would enter into a non-profitable job because you really truly believe it's going to lead to other profitable jobs. Because otherwise, what you're doing is paying someone else for their job. Right? I mean, that's what you're doing. You're taking out of your savings and give it to some other company that can afford to pay you even more. So that means you priced it wrong and you wanted that job and sometimes you just got to walk away for jobs that, they won't pay you more. And then what happens is you may have priced it where it's going to be a 35% margin. But they came back and said, nope, we can't pay you, revenue of 100,000 on that. We'll give you 90. You got to rerun those numbers to see where it comes. And does that make sense? To, for you to enter that job, can you just now walk away? You gotta make those hard decisions. So contract schedules, right? How does it relate to the income statement? How does it relate to the balance sheet? And we kind of talked about it. Remember when I said you got paid early, it's going to hit your balance sheet, not necessarily your revenue statement, right? You got paid early from the client because if you just 5% in the job, but they paid you 100%, then that revenue is not going to hit. If you got a good accountant, they'll know that revenue, a percentage of completion contract, it is not going to hit your income statement. Yes.
So some people do cash basis and who's on you get cash basis.
Right. So it depends, right? Contractors are supposed to do, right, the percentage of completion method, right? But if you have a related business, but you're really a contractor, then you're right. You'll be on the accrual method of accounting. And so even that, it's really the same concept. Most of that cash will be sitting, will be in cash as an asset or in liabilities because you haven't worked the job yet. So you'll accrue back. Now, the IRS is me. So I should say that. They're really me. That ain't something about. And then listen, I do taxes. I am not an IRS agent. Some people are like, oh, you must be mean yourself. I'll help you save money. I'll help you fight them. But in those situations where you get prepaid, they want you to pay the taxes off that money. So for book purposes, you're following accounting. And the accounting saying that's not revenue for. For tax purposes, they know if they ain't gonna listen, they're gonna spend that money. So we need that money now. Like, you give us that money now, so they got to pay 100%. I want to see those taxes. Now, they do let you follow percentage of completion method generally as a contractor, right? Construction contractor, right? Anything else, they're like, nope, you can't follow that. You got to put that all in revenue, which is great. There, you got that cash, you want to see it. Yeah. So there's something else. So just know about these costs, your variable costs, your fixed costs, and your semi-fixed costs, right? So variable cost, right, goes to buying, right? So if you have employees who are working on particular jobs that you had, those are your direct costs. You have direct materials that will help you complete that job. Those are generally the course, and they vary, right? If the person's working, if you estimate the person goes about 80 hours, right? So, and then all of a sudden the volume increases of the job, they have to work, 200 hours instead of the 80 hours. Well, you're applying that cost to that particular job. That's why the cost varies. Right? So even though some people think of their fixed costs, I have to pay them their regular employees. Well, treat them if they're contractors. So some of you guys have contractors, right? And you only pay them if they work. Right? So that's the perfect example of a variable cost. If they're $80 with the 200 hours, guess what? The cost goes up. You know what the rate of you paying them, so that's the variable cost. That's a great example of it. It's still even with employees fixed as well that works on jobs for you. Because now you're allocating their salary to each of those jobs and understanding the job costs. Fixed costs that basically don't change. It's not, no matter what happens, no matter how many jobs you get or how many jobs you don't get, it's gonna stay the same. So if you rent space and you rent it for the year and you're in that contract for a year, that rent is not going to change. It's a fixed cost. It doesn't matter, right? It's a total fixed cost. I think I have on cards instead of cars. Cars in the air, get the idea out of it. But, leasing charges for Salesforce. If you're paying a certain amount on that lease, it's fixed.
Question. Yes, I have a question about overhead. So I have this all fixed costs and variable costs and then receipt every day count and to see that overhead is always like 80% and we cannot get rid of it. We see that we need more contracts than cut our
Right, the overhead. Well, see, because a lot of it is, I mean, so overhead a lot of times are the fixed costs, right?
Yeah.
Huge fixed costs, and it depends. You know, like big organizations, overhead is management is a big example of that. And the only way you can cut that is to cut their salaries or cut them. And so you're right. It's very difficult to reduce overhead unless you make hard decisions. And that's the problem. You have to make hard decisions. And that sometimes means cutting people or using technology to benefit. And that's what you see now. Companies that are doing extremely well have used technology to their benefit to reduce those costs, which means a lot of times you get people go, right? Or if you can redeploy them to do something more valuable that now revenue generated, then that helps you. So instead of cutting them, you kind of redeploy them to help you with your business. But you have to make that decision. Especially if it's 80%, you have no choice and to cut it, because what happens is if, like we're going to do a crazy time with the federal government now. So we don't know what the impact that's going to be to any of our jobs, right? We have no idea. You always have to have cushion for that. Like I would say, when I worked at Alder Anderson, one of the things they did, they were like the top firm in the world, but they basically paid people 80% of the market. And the reason why they did that, and so they let some people go because they were really conscious about doing it. The reason why, if something happened, war happened, and all of a sudden the economy was hit, they were laying off less people than all the other firms because they had built a cushion to make sure they can get through hard times. So if you're
I like that point. Just to amplify that for this class again, like, what do they need to do to build that cushion? Like, what does that number look like? Is that like 6 months worth of revenues? Like, what are some best practices that each and every one of them should look to adopt tomorrow?
right. So my thing is, and it's the same thing.
It might not differ for each company, but
Right, it's definitely different with these companies. How I do it, like when I teach the class the finances to young college students, teach about savings. And we go, you can, when you first get your first check after you graduate college, then you got debt, you got this, you got that, but you got to start saving. So if you first start saving, we show $50 a paycheck. You put it in the bank, keep it. I was at $600 a year. Or you can go 50, 50, 50, 100. 100, 4 or 5 months, 150. And it's the same concept, is that it's difficult for you to apply a wholesale change today. But what you can do is plan for it 6 months, a year down the road to say, okay, my margin right now, say my overhead, just 80%. I want to get it down to 70% by the end of the year. And I want to push to do that. And then the next year, by the end of that year, I'm going to get it down to 65%. And I'm just going to make this hard decision. And saying, my management team going, no, this is what we got to do to get it done. That's how you do it gradually. You don't do it overnight. Because when you do it overnight, you up the system. And guess what? We see the federal government. You may pay commission for them. So maybe now they're out there $100 like you are, right? They're trying to get these business for you, whatever. And you're going to sympathize them. You're going to say, you know what? I'll give you 5% of something that you brought in. That's a variable cost, right? Because they brought it in. Otherwise, they still get their salary, but they get more because they brought it in. And I'm going to give it to you when the cash comes in. That's the important thing too. You're not going to give someone 5% and because they'll be sounding the dollar line and when they get the cash. They're going to help you get that cash too.